Buffett says, "I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, so we don't use it. We don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Joe Manhalan wrote that you're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions were, first, what is Buffett waiting for, and second, why not at least deploy some of it? The world's most famous investor, Warren Buffett, owns an astonishing $182 billion in cash through his Berkshire Hathaway company. Unless he noticed a concerning development, why would he sit on such a large cash pile? Is this a hint of an impending market crash? What effects will this have on your investments? We'll examine in-depth Warren Buffett's most recent financial decisions in this video. Examine the signs of a possible market correction and consider the implications for the typical investor. Let's examine the rationale behind Buffett's cautious approach and the implications it holds for the stock market going forward. Berkshire Hathaway's massive cash reserves have recently garnered news, thanks to Warren Buffett, who is well known for his smart financial methods, which have increased to an astounding $182 billion. He explains that this is not the result of being a miser, hoarder, or anything similar. Rather, it is a calculated move. Our group lives extremely well, but the math of compound interest and a long runway have worked wonders, and we will discuss this later, just before lunch, and we'll provide an example of what can be accomplished with that kind of thinking. Our cash and treasury bills were $182 billion at the end of the quarter, and it's reasonable to assume that they brought in another $200 billion. While we would love to spend the money, we won't do so unless we believe we're undertaking a venture that carries a very low risk and has the potential to generate significant profits. This statistic is a signal, not just a number, and comprehending its meaning necessitates looking at Buffett's investment philosophies as well as the larger economic environment. In the past, Buffett has recommended saving funds during periods of market overvaluation in order to profit from market declines by investing in assets that are undervalued. This methodical and patient approach seeks to optimize long-term benefits as opposed to immediate returns. What's most notable about Berkshire's cash pile is its size, because it differs greatly from conventional operational reserves, indicating a deliberate approach to buying opportunities that present itself during market crashes. In order to comprehend this, let's examine Warren Buffett's statement that stocks are currently at a point when purchasing shares modestly increases their worth. Though you can't buy it in a big way because people don't want to sell it in a big way, we would really like to buy it in a big manner. However, if certain market circumstances are met, we may spend a significant amount of money on repurchases. Given the present returns on cash equivalents, such as short-term U.S. Treasury bonds, which are yielding 5.4%, this conservative approach may seem illogical. These gains are not insignificant, particularly in a low-interest rate environment. Buffett's choice to maintain these assets suggests that he values safety and liquidity over larger but riskier market returns. It is his opinion that given the current state of the economy, which is rife with speculative activity and high valuations, there are no possibilities in the market that warrant taking on risk. Motivate to analyze Buffett's technique, one must comprehend the role that cash plays in investment strategy. In addition to serving as a hedge against market volatility, cash can be used to take advantage of fresh investment possibilities without having to sell off current holdings at a loss. When the proper moment arises, Buffett and Berkshire, as a result, may move quickly and decisively because of this strategic reserve and the amount of money available. Holdings are a good way to evaluate how Buffett views the pricing and stability of the market. A growing financial reserve during periods of widespread financial corrections are often preceded by market optimism. Buffett has a history of building up cash during strong market times and spinning during downturns. This strategy has allowed Berkshire Hathaway to continue growing and stable over the long run by keeping a sizable cash reserve. Buffett is safeguarding Berkshire's assets against future market devaluation in addition to getting ready for a slump. This strategy emphasizes a key idea in investing. Capital preservation is just as vital as profit growth. Given the extent of this cash reserve, it is evident that Buffett is preparing for big market moves in the future. Astute investors should be aware of this strategy's potential effects on future market patterns and their own investing choices. The so-called Buffett indicator, which contrasts the total market capitalization of U.S. publicly traded firms with the GDP of the country, has been a favorite tool of Warren Buffett's for evaluating the state and value of the stock market. At 199%, over twice the GDP, this metric is currently at an uncomfortably high level. The significance of the Buffett indicator, which compares the valuation of the stock market to the actual economic output of a nation, lies in its historical accuracy in identifying economic bubbles. When the ratio exceeds its historical average, the indicator highlights discrepancies between the price of stocks and the real economic value they represent. This level is more than just a statistic, it is a clear warning of market overvaluation. Significantly, it implies that stock prices are higher than what historical economic fundamentals would justify. Historically, whenever market cap has sharply exceeded GDP, a correction has ensued, bringing prices more in line with actual economic conditions. At the moment, the 199% of the Buffett indicator is almost 2 standard deviations above the historical norm. In statistical terminology, a standard deviation is a measure of variance or dispersion around a mean when a data point, in this case, the market valuation, is present. This makes the deviation noteworthy. When a market deviates this much from its average, it signifies a serious abnormality that usually comes before a return to mean levels or a market downturn. This phenomena is not just the result of statistics. It also reflects larger economic trends and investor behavior when market valuations are abnormally high compared to GDP. It frequently means that speculative investing is commonplace and that investor mood rather than company fundamentals is driving price increases. In these conditions, there is a greater chance of market bubbles since investors purchase more stocks not because of the company's inherent value, but rather because they anticipate profiting from price increases. When the Buffett indicator reaches such high levels, it is evident that investors are paying more for securities than there are increases in the underlying economic output, which leaves the market open to large corrections. Buffett's reliance on this indication implies that buying in an overpriced market should be done cautiously, when the risk of a significant adjustment outweighs the potential for growth. Knowing and keeping an eye on this indicator can offer crucial insights into the state of the market, enabling investors to make well-informed decisions about when to invest, hold, or sell assets based on longer-term economic signals rather than cyclical fluctuations in the market. In the current economic environment, interest rates and their relationship with asset preservation and risk management should take precedence over aggressive growth methods when it comes to individual investors. This means that during periods of high Buffett indicator readings, investors should proceed cautiously. Decisions about investments are heavily influenced by market mood, especially when considering Warren Buffett's cautious approach. The historical anomaly of the Treasury yield curve inversion, which has persisted for over 630 days, is a critical indicator. It happens when short-term interest rates surpass those of long-term bonds, indicating that investors anticipate short-term economic challenges followed by longer-term stability or growth. A fundamental understanding of what the yield curve represents is necessary to appreciate the importance of this inversion. Since maintaining an investment for a longer length of time entails risk, long-term bonds should typically yield higher returns. When this trend inverts, it indicates a lack of confidence in the near-term economic outlook. Market players believe that in the future, the central bank may cut interest rates to boost a flagging economy. It thus raises the cost of longer-term bonds. Every recession since the 1950s has been preceded by this phenomenon, indicating that the yield curve's sustained inversion has been a reliable recession predictor in the past. The current prolonged inversion suggests ingrained concerns about the immediate economic prospects. In addition, the current return on short-term U.S. Treasury bonds, which is approximately 5.4%, represents an abnormally high yield in what has been a historically low environment globally. These yields have become attractive, offering safe and decent returns in uncertain times. Despite surface-level market optimism, Buffett likely takes the DI economy into serious consideration when making his investment strategy, reflecting his preference for safety and liquidity over higher yields that carry increased risk. Buffett's strategy of keeping sizable holdings in cash equivalents rather than making investments in volatile assets or high-performing stocks emphasizes a defensive posture with the goal of protecting capital for individual investors in the face of market overvaluation and economic uncertainty. Due to his reputation as one of the most successful investors in history, as well as his exceptional ability to predict significant changes in the economy, Warren Buffett's investment decisions have long been a topic of discussion among analysts and investors. At this time, his actions, or notably lack thereof, evidence his assessment of the state of the market. Buffett has demonstrated a pattern of building up liquidity and anticipating market downturns in the past. For instance, during the late 1990s dot-com bubble, Buffett was criticized for not investing in the booming tech sector, but his caution was validated when the bubble burst in the early 2000s. Buffett's historical approach and current strategy shed light on how he views the current state of the market, and in the comparable downturn that preceded the 2008 financial crisis, he was able to buy priceless assets for a small portion of their original price. Buffett's Berkshire Hathaway is keeping a $182 billion cash reserve, a move that is similar to his past market peak actions and goes beyond simple caution. Buffett's Berkshire Hathaway previously held sustainable cash reserves that enabled him to make opportunistic purchases when prices plummeted, but a tactical stance that gives him the freedom to make large investments when the going gets better. Buffett's recent behavior suggests that he may be expecting a similar market correction soon. His reluctance to make large investments in what he believes to be an inflated market is consistent with his long-term investment philosophy. When others are greedy, be afraid, and greedy when others are afraid. Buffett has also demonstrated strategic restraint in his current investing behavior. Despite having cash on hand, he has reduced his positions in several large holdings and has not made any significant new investments, indicating that he believes the market is not currently providing the best value for the risk involved. Instead, he has chosen to hold out for a more alluring investment opportunity that satisfies his stringent criteria for value. Buffett's strategy also highlights the importance of a basic investing principle: waiting for the right time to deploy capital to minimize risk and maximize potential returns. This disciplined approach involves careful analysis and patience to determine when and where to invest. In a market dominated by speculation and quick profits, individual investors can learn a lot about strategic planning and restraint from Buffett's current activities. Buffett's commitment to long-term value and safety has not wavered. His actions imply that investors should exercise caution, especially in an environment with high valuations where there is a chance that a reversal could result in significant losses. Although Warren Buffett's present approach is cautious, it is based on realistic assessments of market conditions and a thorough comprehension of economic data, because, as always, he makes decisions with the intention of not just protecting money, but also positioning himself to take advantage of opportunities in the future. As we wrap up this critical discussion on Warren Buffett's warnings about a potential stock market crash, it's essential to distill the key takeaways and understand how we, as investors, can navigate these turbulent waters. Warren Buffett, a seasoned and highly respected figure in the investment world, has highlighted several indicators and economic signals that suggest caution. His advice is not to incite panic, but to promote preparedness and prudence in our investment strategies. Buffett's insights into the overvaluation of stocks, increasing debt levels, and geopolitical uncertainties serve as a reminder that the stock market is inherently cyclical. History has shown us time and again that what goes up must eventually come down, and the ability to recognize these cycles can make a significant difference in our investment outcomes. By paying attention to fundamentals, maintaining a diversified portfolio, and avoiding the herd mentality, we can better position ourselves to weather potential downturns. It's important to note that while Buffett's warnings are based on sound analysis, predicting the exact timing of a market crash is nearly impossible. The key lies in being prepared rather than trying to time the market. This means having a robust investment strategy that includes cash reserves, defensive stocks, and perhaps even some exposure to alternative assets like gold or real estate. Additionally, staying informed and continuously educating oneself about market trends and economic indicators is crucial. For those of us who are long-term investors, Buffett's philosophy of buying quality companies at reasonable prices and holding them for the long haul remains relevant. Even in the face of a potential market crash, strong companies with solid fundamentals tend to recover and thrive in the long term. Therefore, focusing on value investing and resisting the urge to make impulsive decisions based on short-term market fluctuations can be a prudent approach. Moreover, diversification is another cornerstone of Buffett's investment wisdom. By spreading investments across various asset classes and sectors, we can reduce risk and increase our chances of sustaining growth through market cycles. This diversification should also extend to global markets, considering the interconnected nature of today's economy. In conclusion, while Warren Buffett's warnings about a potential stock market crash are certainly cause for vigilance, they should not lead to fear-driven decisions. Instead, let's use this valuable insight to reinforce our commitment to disciplined, informed, and strategic investing. Remember, the goal is to build a resilient portfolio that can withstand volatility and capitalize on opportunities that arise from market corrections. If you found this discussion insightful and helpful, please give this video a thumbs up. Your support helps us continue to create valuable content for investors like you. Also, don't forget to share this video with your friends and family who might benefit from understanding Warren Buffett's perspective on the stock market. And most importantly, make sure to subscribe to our channel, Investing Tutorial, for more expert insights, tips, and tutorials to help you navigate the complex world of investing. Hit the notification bell so you won't miss any of our upcoming videos. Thank you for watching and happy investing.